If you are looking for a blue chip dividend ETF, XEI may just fit the bill. Fasten your seatbelts, folks. This is going to be a good one. The iShares S&P TSX Composite High Dividend Index ETF, or just XEI, is a very popular ETF for investors looking for stability with some dividends on the side. This ETF does just that, as it was created back in 2011 with a goal of generating capital growth while also providing a healthy dose of dividends. To accomplish that, this ETF maintains a basket of stocks from the S&P TSX Composite High Dividend Index, just as the name suggests. One of the core concepts of this ETF is lower risk, and that is why most of the stocks in their basket are blue chip, thus making this ETF very much blue chip as well. They are a good, solid, circle the wagon foundation ETF for sure. Of course, the price for this safety is that they are not employing covered calls or leverage, so that does limit their dividends. However, it does mean that they have a lot of potential for some solid growth in a strong bull market. When we look at the growth over the last 3 years, we are going to not fully see their potential, as we did have a bear market and companies struggling after that with higher interest rates. However, as rates come down and recovery becomes the theme of the day, this ETF may just have a pretty interesting story to tell. I do love a good story, and a sub to the channel would be a happy plot twist for sure. I did dig into their annual report for 2023, and there was, of course, a lot of interesting information. One thing that caught my eye was a breakdown of returns over the last 10 years. Their best year was 2021 with a return of 35.65%. And on the flip side, their worst year was 2015 with a return of negative 14.67%. Overall, they had positive returns 7 out of the last 10 years. Another interesting tidbit is that their net assets increased from $1.34 billion to $1.55 billion in 2023. Growth is a good thing for sure. On the topic of growth, they returned 6.74% in 2023. Compared to the index that they replicate, which came in a little bit higher at 6.97%. Yes, they came below the benchmark, but once you account for the management fees, it is pretty much dead on. I think it is time to dive into some numbers. So if we are going to hit the digits, we need to call on the digit dominator himself, the one and only Mr. Math. We will begin with some surface data. They have a current value of $25.70 at time of recording. Their NAV, that comes in at $25.82. Those assets under management coming in at $1.56 billion, and they have a beta just a little bit less volatile than the market average at 0.91. Their average volume is not too shabby, coming in at 84,967. Their return on equity, that comes in at 13.11%. And they have a return of assets of 3.91%. These numbers look good, and I did notice that their $1.56 billion assets under management is already up from the $1.55 at the end of 2023. So it's moving in the right direction. Let's peel back a layer and take a look at some of the fund specifics. We will start with those fees. They have a pretty low management fee of 0.20%, and that management expense ratio, that comes in at 0.22%. These are, they are pretty low management fees overall, and I do like that, as it is always good to see more of the money coming back to us in the returns. If we look at their holdings, their top 5 includes TD Bank at 5.14%, Royal Bank at 5.13%, TC Energy Corp also at 5.13%, Suncor Energy at 5.04%, and Enbridge at 4.98%. Looking at those companies, I have a feeling their diversification breakdown will be a no-brainer. So in regards to diversification, their top 3 sectors include financials at 30.11%, energy at 29.99%, and then utilities at 13.95%. It almost goes without saying that if you have a performance ETF in Canada, Energy and financials aren't going to be your big hitters. Let's take a look at their dividends and returns. They have a dividend yield of 5.271%. It is a monthly dividend of 11.3 cents per share. Their 5-year average dividend increase is 5.05%. So that is a little bit low for people looking for growing dividends. Even with an average increase, it is still important to point out that they recently lowered their dividend from 12 cents to 11.4 cents. And their next dividend, it's been reduced again to 11.3 cents. I never like to see things going down like that. So that certainly is concerning. On their returns, on the 3-year, their return on investment comes in at 8.90%. Factor in the dividends, we get a total return of 24.17%. On the 1-year, the return on investment comes in at 3.71%. Factor in the dividends, total return 9.17%. Looking at this year to date, their return on investment comes in at 3.88%. Sprinkle in those dividends, we get a total return of 6.72%. These returns, as I hinted to at the top of the video, do reflect the bear market and those rising rates. I do not feel like they fairly represent how this ETF will do in a stronger bull market. And I suspect better results going forward with additional rate cuts on the books. With that being said, these returns nonetheless, they're not that bad. So what is my final verdict? This is an easy one, as it is exactly what it is trying to be. We are talking about a blue chip circle the wagon foundation ETF. This ETF may not be flashy, but it gets the job done. It is ideal for lower risk investors who want some dividends, but not at the cost of additional risk. It is a good ETF for long-term capital growth with moderate income. The income investors will more than likely pass on this ETF, as there are better options to gain the same exposure with a little more risk and more dividends, of course, for that risk. I think as we move into a stronger bull market, it may be one that has some potential to get total return investors excited. As I said before, I do expect a strong 2025 for this ETF. If you are interested in XEI, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on XEQT. Thank you for watching, and I will see you in the next video.